What type of clients do we have, first of all, in Citi Private Bank?
So Citi is slightly different insofar as obviously we have a huge retail banking presence. So we typically start on the private banking side at about $25 million and upwards. Below that would be covered by Citi Retail, Citi Gold or Citi Gold private clients. So we have a little bit more segmentation than you would expect to see with other private banks who perhaps don't have the retail franchise underpinning that. Private clients are very different from retail clients. They have become more sophisticated more quickly, we think, since 2008, which incidentally we think is a
rapid education experience over the last
I think
10
that's
years.
absolutely right, and I think it's actually good because it means that we can have a much more evolved dialogue than we used to be able to. And we've talked in this conference about things like risk management, asset allocation. These are now underpinning every conversation we have with our clients.
And the clients understand that better?
They do, and I would say that although they've been through this education process, they're very smart generally, and they do get it. And risk management now really is very important to them. They've seen and they've understood the risks of investing in all asset classes. They've seen the benefits of diversification into fixed income, which in Asia has not historically been a huge area for them, but over the last 2 years prior to May of 2013, it was a very interesting place for them. Obviously now as we move into 2014, we're seeing less interest in fixed income, a slight gradual increase from an equity standpoint, in particular US equities still, European equities and North Asia equities.
And is that advice directed, or is this something that the clients themselves want?
It's a good question. It's actually, we think it works best if it's a combination of the two. Clients are...
So a consensus, in other words?
Not always consensus, but I think that there's just a view that everybody wants to thrash out these issues and have an intelligent conversation about them, and we will always have a difference of opinion as to what implementation steps we take, but at least challenging each other's views, I think is a much more constructive process than perhaps we've had in the past, where it's been a perception very much as this is today's product, let's push this product and then move on to the rest, or the next one. I think we've moved away from that. We're trying to be a little bit more holistic, if you like, in the way that we talk to clients, and I think they're pretty receptive to that.
So clients are not necessarily just buying funds, they're buying all sorts of other products as well, aren't they?
Well, and that's the benefit of private banking. So obviously mutual funds are the bread and butter of
is that a core investment for them?
Yes, I would say that for clients who are active in what we call managed investments, then you would expect, typically speaking, that 35 to 40% of their managed investments allocation would be in mutual funds. If you then go back to the consumer bank doesn't have quite the same breadth of investment platform, so the percentage in mutual funds will be much higher. But in the private bank we have a lot more flexibility. So in addition to mutual funds, we also have hedge funds, we have private equity, we have real estate, we have discretionary and advisory portfolio management services. So mutual funds still the biggest percentage of that, but the other areas are seeing a lot of interest, and in particular on the alternative side. And again, we've talked about that in the conference today so far. The demand for hedge funds has picked up dramatically.
Because it fell off a cliff, didn't it?
It was terrible for 5 years, from 2008 to 2013, and then you started to see the following happening.
But do you think people were too heavily invested in hedge funds before, and therefore they lost money, now they've sort of taken this long to get back to it?
It's a really good question. I think that for retail clients and private banking clients, the problem was not that they had too much in absolute weighting to hedge funds, but perhaps that they chased a relatively small number of funds which had had very good performance. And then one of those funds, if one of those funds had had a problem, or for example in 2008 had to suspend redemptions or create special purpose vehicles, side pockets, etc., their perception of the whole asset class was tarnished. Fast forward to 2013, and we'd started to see the risk-adjusted returns of the asset class improving, and now into 2014, that's been going on for about a year, and so we're seeing clients increasing their allocations from a very low base, as you pointed out. But selectivity is very important. You can't just allocate to the whole asset class. You need to find the best of breed.
And when you talk about risk-adjusted return, that doesn't mean absolute return, does it?
No, it doesn't, and I think that's a perception, or sometimes a misperception that clients have, is that the hedge funds to an extent had portrayed themselves as absolute return, and in fact many of them were not necessarily specifically absolute return, but they might have been risk mitigated in some way, but without necessarily having an absolute return mandate. Some of them obviously are. And I think that it's been an education process for our clients to differentiate between the two, in the same way that we also spend a lot of time working through with them the concept of market neutrality of hedge funds. Many hedge funds prior to 2008 were putting themselves forward as market neutral, and 2008 showed us that they weren't in fact market neutral. So which ones genuinely are market neutral and uncorrelated, and which ones still have an element of directionality to it? And that's a much more constructive conversation to have with clients.
Also, you mentioned co-investment and property. That suggests longer term or longer time horizon for investment. Is that correct?
Absolutely right. So clients in this part of the world, particularly high net worth and ultra high net worth clients, have in a large number of cases made a lot of their money from real estate. But what we can do is not necessarily replicate the real estate investments that they can do themselves, but we can help them diversify into Europe, into the US, into Latin America. We can do it via funds, we can do it via club structures, or we can do it via single asset co-investment, so individual development.
So it's not like just buying a flat in Knightsbridge or anything like that?
Of course they might want to do that, and we can help them with that on a sort of a referral basis, but in reality they like the development aspect of it, and they like the sort of diversified nature of it, not just buying necessarily
one asset. Do they like
one
doing it with other similar-minded people, as it were? So you said club or co-investment.
Absolutely right, and I think that's the whole benefit of a club structure. So when a client decides that they want to allocate a certain amount of money to a fund, then we create a club structure around it, and in return for that, the manager of the club will undertake to show them a handful of deals each year, which the client can specifically decide whether they wish to participate in.
Are those fund managers coming to Citi with ideas, or are you going to managers and saying, this is what we'd like, could you fix it for us?
Well, I think that we've been at the vanguard of the development of the club structure, certainly, but in terms of the asset class approaches that we get from the asset managers more broadly, then I think it's very much a two-way dialogue. But specifically on clubs, I think that we've been leading the charge on that. We've also been very explicit with our managers that in addition to blind pool funds, we would like to see more single asset co-investment deals as well. So I think it is a two-way process, but certainly we are.
The single asset suggests a higher risk profile as well.
Absolutely right, and that's what's interesting about it. I think that clients in this part of the world do still have an appetite for allocating.
So risk on.
Yes, risk on. Serious amounts of money into individual assets with poor liquidity, with one constraint. They want to know what it is before they write the check, and if we can give them that transparency, then they are participating in it.
So now we're just starting the second quarter of 2014. We've had a pretty good run. American markets are back up to all-time highs. And do we see people still wanting to invest? Do we think there are still opportunities out there?
Yes, absolutely. And what we're actually seeing is clients that have been allocated to US equities over, say, the last 1 to 2 years are now starting to shift some of the profits they've made into European equities. We're seeing more interest in certain parts of emerging markets, not global emerging markets, but certain parts of emerging markets, in particular North Asia. We're seeing clients in this part of the world of the view that China equities are very strongly supported from a valuation perspective. There may be some sort of inflection point coming, so there are definitely some opportunities.
Opportunities everywhere.
Opportunities everywhere, but also I've mentioned from a geographical standpoint, I would also like to isolate specific sort of thematic equity plays. So for example, disruptive innovation, shale gas revolution. These are things that you can pigeonhole, you can ring fence with specialist managers and make available to clients who believe in the
There must take a lot of time to get the research to find that information and find managers to do that.
For sure, and that.
So you're investing time into that?
And we have research teams around the world whose only job it is to unearth these ideas. But the reality is that these types of investment proposition do not manifest themselves to the market via mutual funds. They might be separately managed accounts, which are then created
or
for
private equity,
or private equity sometimes. But obviously, we try and have a good balance between liquid and illiquid.
So, given the types of portfolios you're talking about managers, private equity, pooled, club, and so on. Mutual funds would probably be more the sort of cash account type of investment in an overall portfolio. Would that be fair?
I mean, I think commoditized, I think, is the word that we used a lot. But I wouldn't see it as a cash substitute necessarily. I would say that they are traded more frequently, more actively, and in particular countries around the region, we see a very active trading of mutual funds, Taiwan, for example. They are used much more rapidly, if you like, to implement specific asset allocation decisions fairly quickly. But I think that the point is that obviously they are an important building block of a portfolio, and the liquidity that they give you is also important. important, but ultimately to differentiate ourselves we have to be thinking much broader than that.
Roger Bacon, thank you very much.
Thank you, Stuart. Nice to see you.